afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Smart Investor Singapore. Now, I'm Brian Fernandez and it's Wednesday, the 21st of November, and we have Craig Erlam, the Senior Market Analyst at Oanda, as our guest today, coming out of the UK. Craig, welcome to the show.
Thanks for having me on.
Now, Craig, I'm going to come back to you in a bit after we take a look at cryptocurrencies and how regional stock markets have performed. We start with Bitcoin, and that's at 16,148. It's down 3.21%. Ethereum is at 1,130. It's down 7.33%. Now, looking across the regional stock markets, not a very pretty picture. We've got the SGX, which is down 0.79%. Bursa Malaysia is down 0.53%. Shanghai is down 0.76%. The ASX All Ordinaries is down 0.21%. The Nikkei is down marginally at 0.02%. The Hang Seng is down 1.91%. And rounding up the numbers, we've got the Kospi, which is down 1.21%. Now, Craig, what's your view on market performance in the first half of this Monday?
Well, I think it's quite clear where the weakness is stemming from. We look at the rising COVID cases in China and what that could potentially mean for restrictions and lockdowns in some major cities, and therefore growth going towards the end of the year. We have to remember that in recent weeks there's been a lot of excitement about the possibility of COVID restrictions being relaxed, and instead what we're seeing right now is steering towards the polar opposite. It's more restrictions and more uncertainty for the economy, and you can see that weighing heavily in China and in Hong Kong, and it's going to throw into doubt, I think, as well, not just what can happen in the weeks ahead, but also there's been a lot of speculation that COVID curbs could be relaxed further in the spring of next year. If we see a bad experience now, then that could potentially fuel thought that China's not ready for any significant relaxation and that more stringent measures are needed. So it has near-term and medium-term implications, potentially, how the coming weeks goes. And I think that's creating enormous uncertainty for stocks which had, as I said, rebounded strongly on the promise of a relaxation. And I think that's what we're seeing filter through, not just in China and Hong Kong, but also then it has obviously negative repercussions as well for the rest of Asia, and we're seeing that quite clearly.
Now, Craig, in addition to that, still on China, China left its benchmark lending rate unchanged for the third month in a row. So the one-year loan prime rate remains steady as 3.65%. Five-year rate is also on hold, 4.3%. But the yuan, again, because of the COVID restrictions, as well as other Asian currencies, has slumped because of the COVID cases. But also the dollar has benefited as a safe haven because the dollar has strengthened on talk of perhaps potential escalation in the Russia-Ukraine conflict. What's your view on currencies then, Craig?
Yeah, I mean, that kind of links to what I was saying earlier, I guess, in that the yuan is obviously intrinsically linked to the performance of the economy, and this now creates enormous uncertainty for that. We are seeing broader risk aversion because you can look at the European futures and you can look at US futures as well, and they're also down. So clearly there is more to this story than just China, although I think China has a negative impact around the world. It's still the world's second largest economy, and anything that knocks growth there can have negative implications on a much broader scale. And so we do seem to be seeing more risk aversion across the broader markets. And as you alluded to, that has benefited the dollar over the course of this year. And the dollar has given back a lot of gains over recent weeks as we've seen that risk rebound in financial markets. So I think this risk aversion today is just feeding back into that little bit of dollar strength. As you say, the loan prime rate that 1 and 5 years were left unchanged. That's not a huge surprise at this point, but it does mean that the PBOC has plenty of room to cut both of those rates, or cut the medium lending facility in the coming months if it's warranted as a result of this surge in COVID cases. And I think if we do see a a rebound in the US dollar, if we continue to see risk appetite improve in the coming months, then that will ease the pressure from the PBOC to enable it to do that. Because one of the concerns recently has been you cut those rates and you're just exacerbating a problem in the currency. Well, if we're seeing a rebound in the dollar, then that alleviates some of those pressures. The difficulty has obviously just been that they've been cutting rates at a time when there just isn't demand. So you're effectively pushing on a piece of string. So there is many more things that needs to happen. And what we had talked about last week, the 16-point plan in the property market, and also COVID as well. I think all these are going to filter through to helping the economy in these very uncertain times.
Now, Craig, the other thing that's concerning investors globally is really that the Fed hawkish sounding interviews by a number of people from the Fed last week. That's probably contributing to the wobble around numbers and this week already at the start of the week. What's your view on this?
Well, I think what's clear is over the course of this year, since the Fed pivoted towards a much more hawkish stance, once it accepted that inflation was not transitory, they've been very conscious of their message being undermined in the markets. And we've seen on a number of occasions investors have leapt at any opportunity to buy the dips or to start to price in maybe less rate hikes. So I think what we're seeing right now is the Fed trying to stay the course as long as it can. I'm not sure maybe these policymakers still believe that as many rate hikes are going to be warranted, or that 75 basis points is really on the table in December. That inflation figure, both the CPI and the PPI last month, were much better than what we had hoped for, and very much on the right track. That doesn't mean that it's sustainable per se, but it's a very good start, and it definitely does send a decent signal. And yet Fed policymakers continue to push back. I think that's because they're afraid of their message being undermined. If they'd have come out with anything more dovish than that, I think the fear for them is that we could have seen a significant weakening in the markets in terms of yields, and therefore a loosening rather than the tightening that they've been moving towards for many months now. If we see
Now,
more weaker data, then I think we could potentially see that language start to soften. But I think right now they want to stay the course for fear of like I said, their hawkish measures up until this point being undermined.
a quick final question. What are some key events and data points this week that you think that will move markets?
So I think the two that stands out is, of course, as we've just been discussing the Fed, we've got the Fed minutes on Wednesday, and I think that's going to be a pivotal one. I think that's really knocked sentiment over the course of the last week, so people will be looking to the Fed minutes and commentary. We've got a number of different policymakers speaking over the course of this week, so I think that's going to be critical. Obviously, it's a shortened trading week in the US as well, with the Thanksgiving holiday. And then there's a bunch of flash PMIs, which again, I think are becoming increasingly important. We're seeing a lot of data suggesting that these economies now are starting to significantly weaken. The UK probably already in recession, for example. And these PMIs are going to give a better indication as to how that's filtering through to business and whether they're becoming increasingly pessimistic or whether we're seeing some stabilization in the numbers. So I think they're going to be really interesting as well. But I think one of the most notable factors of this week is going to be that shortened trading week in the US, because we know that can play havoc, I guess, with how the markets trade, because obviously you can imagine people are probably taking a bit more time off, making the most of those 2 extra days towards the end of the week, and that can sometimes have a dampening effect in terms of trading volumes and therefore impact volatility as well.
Now, Craig, thank you very much for coming on the show. Thanks a lot for your insights.
Thank you.
Now, we've been speaking to Craig Erlam, Senior Market Analyst at Oanda on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.